thank everyone for coming this evening. I am glad you're here because we're at the beginning stages of a pretty historic moment. In fact, never before in the history of our country have we experienced an event like this. And never before, I would tell you, that in the history of the world that we've experienced a specific event that we're going through now. Now, what I'm speaking about is not so much a singular event, but rather a series of conditions that are changing and getting bigger every day. It will absolutely affect everyone in this room, and over the next 30 to 50 years, have a pretty profound effect on America. And whatever we do, it's not going to stop. But so we have to, now what makes it interesting is how, as a nation and as an individuals, we're just radically unprepared for it because we haven't experienced it before. And what you might be wondering is, well, what are you talking about? I thought you were going to do a seminar on taxes and retirement. And, well, I am talking about retirement. Now, retirement, everybody might have a definition of what that means, but what I'm talking about is over the next, right now, 70 million people will be retiring at the exact same time. In fact, over the next 15 years, more people will retire than in the cumulative history of anyone in our country. So if you're a student of history and you study demographics, you would realize that this retirement is actually quite rare. In fact, in 1934, when Franklin Delano Roosevelt passed the Social Security Act, the retirement age was 65, yet life expectancy was 62. Point being, the retirement bill was never intended for the masses, let alone 70 million people, and we're just radically unprepared for it. I mean, consider our leadership today. They have a hard time agreeing on what to have for lunch, let alone think about the hard economic problems that you have to deal with Social Security and Medicare. And as an individual, if you think about, most people just simply haven't saved enough over the next to make their money and income last over 30 years. So I'm telling you this evening not to scare you, but just to be honest and tell you the truth, that you need to take reasonable steps to protect yourself when it comes to retirement. And that's why we're here tonight, because my hope is that I can give you some strategies, some ideas, some techniques, and some tools to put you in a far better place. And that when you talk about retirement, that you'll be in a position not just to survive retirement, but to thrive and to enjoy many of the things that you've worked so hard to achieve. So, my name's Brad Cantrill. I'm an advisor, and I'm going to be here this evening talking to you about taxes and retirement. So, before we begin, just kind of a few housekeeping things for you. You have some packets in front of you. I've put some notes down for you. Feel free to take some notes as you go. Whenever I go to an educational workshop, I always like to draw a line. My goal is to get takeaways. So on the left hand of the line, I always want to write down good ideas, and on the right hand line, I always want to write down action items. So I want you to get as much as you can. I want this to be fun and interactive. This is an educational workshop, so I'm going to try to cover a lot of material tonight. I want it to be valuable for you. But if you do have a question, just feel free to raise your hand and stop me, and let's talk about it a little bit more. I want this to be fun and interactive. A few words from our sponsors at our good compliance department. So I do have a firm in Frisco, and there's my disclosures here. And then, of course, please note that I'm not employed by, endorsed, or even particularly like the IRS, the Social Security Administration, or any other government agency. That anything we talk about tonight is strictly for illustrative purposes only. Because I'm talking to a larger group, it's going to be a little bit more general in nature. If we do have to talk more specifics, I'll be here later one-on-one, but I do need to kind of keep that general so everybody can get benefit from the class. All of this is, like I said, for illustrative purposes, and I'm not giving any specific tax advice. So if you want actual tax advice, please contact a qualified advisor. So with that, what are the goals? Well, I want you to understand a lot of the relevant changes that have happened with respect to personal income tax, more specifically after the Tax Cut and Jobs Act. I want you to identify several tools and strategies that will be beneficial that you can immediately impact for retirees. I'm going to talk about risk specifically associated with retirement income, and I'm going to talk about a lot of variety of general topics that I think are actionable. And then I'm going to spend a few minutes towards the end of previewing what's to come. The tax code is an evolving creature. We're actually possibly going to get new legislation here in December. So I'm going to talk a little bit about that as well. And I also have a blog about it in your book. So that's kind of what I'm going to do tonight, and I'm looking forward to interacting with each of you. So do you recognize these people? It's okay, you can laugh. So these are the people that got the free copy of TurboTax, and they're trying to do their taxes on April 15th. So the reality is the tax code and tax reform can be rather complicated. There's over 56,000 pages of code, and it's an ever-growing mass of stuff that most people don't understand. Point being is, this is not the opportunity, in my opinion, to do it yourself. You need to work with somebody. You need to take the time to find a qualified professional. So I want to start by jumping into what I feel like are some of the most underutilized topics of the tax code. And I want to talk a little bit about the brackets themselves. Starting with ordinary income. When we talk about ordinary income, what we mean here is we're talking about things like W-2 income, interest income, salary, IRA withdrawals. And as you can see from this chart, as you move up, then obviously the income is going to increase. So starting here, you can see examples of how that would work. Now, what I'm talking about here is marginal tax rates and the importance of understanding where you're falling on the tax code. Because right now, under the Tax Cut and Jobs Act, you have some very specific opportunities to take advantage of new laws. I want to show you a tax map that will kind of illustrate where these things are falling and the potential breaks that you might see in the tax code. So notice here that from 0 to almost 30,000, you actually have no tax. That's using the standard deduction, which is $24,700 plus the $1,300 catch up, so you get to roughly $27,000 in tax-free income. At that point, you start seeing the tax income kick in, and you can see various areas where there are pretty substantial breaks in the tax code. So here the 10 to 12% and the 24 to 22% are pretty substantial. Now I want to tell you something that's a little different versus now versus the world of the former act, and I'm going to use something that you don't hear very often when we talk about taxes. The tax code is on sale. And what I mean by that is, right now, compared to where the taxes are, you're getting lower brackets or expanded brackets at almost all the different income levels. It's usually about 15 to 20%. If you look in your packet, I've provided you with a white sheet that actually gives you the differences between the old and the new brackets. It's pretty substantial. So takeaway here is, if you know that the tax brackets are on sale historically, and we've seen this movie before, where we get tax cuts and then nothing's done and then the tax code falls off. We saw that in 2001 with the Bush tax cuts. It fell off at sunset, and then we reverted back when the Obama administration took over and we got new tax rates. Again, when this administration passed the tax code, it's on sale again. So this is set to stay on the books till 2025. So, or sooner if we have an election and we get changes, but for now this is the law. So takeaway might be, if you know that the tax code's on sale and it's running at about 15 or 20% less, one of the things you might want to think about when you talk about tax planning is, are we taking full advantage of paying taxes now versus paying taxes later? It seems a little counterintuitive, but in many cases this could be beneficial to take a look at. So this is thinking about it with respect to ordinary income. Now, capital gains and qualified dividends are a little different, and there have been some changes here versus the old rules. Now, capital gains and dividends have the ability to stand on their own. They do interact with the ordinary income and the marginal tax brackets, but you certainly have the ability to just pay capital gains taxes and take advantage of the lower rates. Public policy would tell you that capital gains and dividends are trying to encourage investments, so that's why they have the lower tax bracket. Does anybody have an idea of what those tax brackets are?
20% or okay?
Well, they can be 20%, but they can be actually as low as 0. And so let me show you what I mean. If you look at capital gains brackets, you can see from 0 to almost $80,000. If you were to have capital gains income and nothing else that would trigger ordinary income, you might be able to take money out just through using capital gains and pay no taxes on the distribution, depending on the facts and circumstances of your case. Point being is, it's important to pay attention to all your accounts, both qualified or retirement accounts and also non-retirement accounts, to manage these distributions. Because in many cases, just taking advantage of the bracket rules can put you in a lower tax bracket. It's also important to think about diversifying your asset base. You know, we've been told or taught that putting the money in an IRA or a 401k is the best way to save, but now with all these different brackets and how they can set up independently, it might be better to think about using other brackets too, and trying to take advantage of those types of situations.
What do you mean by brackets?
Okay, so go ahead. With the brackets, so right here, it has its own independent income tax bracket, the capital gains bracket. So if you had an account and you earned $20,000 in capital gains, and you didn't have a lot of other ordinary income, and you didn't have enough income that was forcing us to marry these with the other ordinary income brackets, then that money that came out to you on capital gains could be tax-free to you. So you do have to consider all of your income together. So if you are taking Social Security and you have some other ordinary income, we have to consider that. But there are situations where maybe I don't have a lot of IRAs, or maybe I have basis in my taxes, and I can use these capital gain rates to keep my income tax down. So these aren't always thought about, but because of the independent nature of these tax brackets, they can really provide you with some serious benefit by keeping these tax brackets low. So this is the own independent bracket for capital gains, and then you saw the one earlier for the ordinary income.
Excuse me.
Sure.
Excuse me. The numbers that you have on the left side, taxable income,
Yes.
that would include what you're considering taking out as a capital gain, correct?
What we're looking at here is just the capital gains. So it's kind of a straight line picture that if I had an account and I took out some money and I was just looking at that particular bracket, then if I had just $30,000 or $40,000 in capital gains, then that would fall under that bracket. There are other considerations too, but I wanted to start with this, just to come, go ahead.
So this is not an income bracket, it's strictly capital gain.
Yes.
Sorry, I misunderstood.
No, that's a good question. So that's why I wanted to try to show the two brackets separate, because what we're used to is ordinary income, and that's why I went to that first bracket first. But then I also wanted to show you an example of what the capital gains bracket looked like, because it's very different. Now the two dance together, so you do have to incorporate those once you get to certain income levels. But if you are controlling your income, if you are keeping your income below certain levels, it's very possible to pay no taxes on certain parts of your capital gains. So, go ahead.
I like your statement that the tax brackets you see are on sale, the tax code is on sale.
Absolutely they are.
Would you include capital gains brackets on sale as well?
If you can pay a 0 rate on taxes, I think that's a good deal. So I would call that on
You
sale.
see them doing nothing but going up.
Well, here's the thing, and I don't have a crystal ball, but this is my opinion. When you have a country that has the challenges that we do fiscally, I don't feel like that long-term that this tax bracket is sustainable. So if you're in a good position tax-wise relative to where we've been historically, and you don't have to go very far back to think about higher tax brackets. I mean, if you think about what we had in the Clinton years or what we had earlier after the sunset provision, those brackets were higher. And I think at some point, there's gonna be a lot of pressure to return to those. So if that's the case, then I would suggest that giving strong consideration to thinking about if the brackets are on sale, maybe it makes sense to go ahead and pay some taxes now and get a deal rather than defer and pay more later. And then it's a little counterintuitive, but if you take a step back and think about it logically, you may come out ahead by doing that.
You mentioned, I'm sorry,
No, you're fine.
you mentioned earlier that 401Ks may not be the way to go, and I just wanted to back that up, because when we took our 401Ks, put them in, there was no tax, but then when we start to take it out, the bite is huge.
Well, so when we started learning about 401Ks, when they became popular, I think it's great that we talked about saving money, but everybody talked about 401Ks being a deduction, right? They're not a deduction, they're a deferral. Because if you think about it, no matter what happens, whatever you earn in the market over time, you're gonna have to pay a proportional amount on the back end. So yes, your taxes do go down in that current year, and I'm not dismissing that benefit. And at times you do have to consider that in your overall plan. But when you let money grow over time and it accumulates, you may find that you're paying far more on the in the back end when your deductions are fewer, and we'll get to that. We'll get to that. So here you can see another example of the tax map and where these things are falling. Notice in the capital gains here, that's a little bit bigger because of those brackets. So, and we're just talking about the capital gains bracket right now. We'll start talking about how these intertwine in a few minutes. So now that I've kind of introduced this concept of brackets and how to use the brackets and maybe some actionable items on how to take advantage of them, I want to talk a little bit about deductions, exemptions, and credits, because there were a lot of changes that happened under the Tax Cut and Jobs Act. So a deduction is simply, if I have a specific amount that I either take the standard deduction or make a charitable deduction, that simply reduces the tax bill on that specific amount. So you can see that we had some changes. You know, when we had the Tax Cut and Jobs Act, we had a doubling of the standard deduction. We also had a lot of changes with respect to itemized deductions. So you can tell that we got a limitation now on mortgage interest. You can't deduct over a certain amount of mortgage interest. Charitable deductions have been curtailed a little bit. You've also seen this popular assault deduction where you limit the amount you can take down on property taxes. So the net result of that is more people are itemizing their more people are claiming the standard deduction because it's become a little bit harder to itemize your taxes. But those are still important, and we need to be aware and pay attention to all the available deductions that you can get. I have some bad news that you're no longer getting an exemption for being alive. The personal exemptions have gone away. That was a bit of a trade-off for having the doubling of the standard deduction. In most cases, this is proven to be a net positive to taxpayers because you weren't being able to claim enough exemptions to overcome the doubling of the standard deduction, but you don't get both. So no more of these personal exemptions for claiming yourself and other people. Credits are very powerful. And so instead of having something specific, like I donate money to charity and I reduce that particular bill, a credit will reduce your total tax bill owed. So it reduces your bottom line number on your taxes. So some examples of credits are like the healthcare tax credit, like maybe Obamacare or something of that nature. and earned income tax credits that you can get for wages and working. Education credits, so we've seen those change a little bit. Child tax credits, those doubled after the Tax Cut and Jobs Act. And savers credits, so under certain situations with certain income levels, you can qualify for savers credits. I want to show you an example of good use of deductions and credits. This is an example of Joe Smith. You know, he's got $38,000 of income. He's claiming the standard deduction. He's over 65, so he gets the additional amount. He reduces his taxable income from 37 down by 27, so we're at 11,000. He makes a $2,000 IRA contribution. That's a deduction, so it lowers his total tax bill to $9,000. But because Joe's also aware of the savers credit, he then uses the savers credit to further reduce his tax bill. So instead of paying the $900 on taxes, he gets a $1,000 savers credit and pays no taxes. So what happened here is he stacks his deductions and his credits. The credit's not refundable, but he does have the ability to take this to zero. So what's the takeaway? By just being aware of some of the deductions and the credits that are here every day in the tax code, you can actually get the IRS here to pay for about half of your IRA contribution. So that's just creative uses of deductions and credits. Go ahead.
I'm sorry, can you just define savers tax credit?
Okay, so there is a public policy credit that encourages people to continue to invest. So if you're earning a certain amount of income, depending on the level of income, a certain percentage of that will qualify for a tax credit. In this case, Joe Smith put in $2,000. He got a 50% credit because of his income level, so he got the $1,000 savers credit. He owed $900 in taxes, and the reason he owed that is because he had $9,000 in income after we took the deduction. He was then able to come back and apply his savers credit, and then he ended up owing nothing. But the best part of it, if you think about it, he got the IRS to pay for almost half his IRS contribution, which is just a good use of deductions and credits. And these things are out here.
So where does the savers, where do you put the money for the savers credit? Where does it,
Well, if you're,
IRA? That's good, it's an IRA.
so if you're filing a tax return, let's say you go through the process and you make an IRA contribution and you get a $2,000 deduction, you're then going to figure out where you're falling on your adjusted gross income. And if you fall within certain parameters, you may potentially qualify for this savers credit, okay? And with that savers credit, that just comes right off the bottom line of your taxes when you file, so that comes back to you.
Is there an age limitation on deductions for an IRA?
Well, there are limitations on how long you can put money into an IRA, but stay tuned because that might change. Yeah, the current rule is you can't make those IRA contributions past 70, but we may see that change. So, and I'll talk a little bit about that.
But this deduction for over 65, was that on last year?
So that's a different deduction, the over 65 deduction. So that was part of the standard deduction, if that's what you were speaking about.
This is 2017, right?
Yes. So here at the top, we started with the standard deduction.
Oh, no, that was last year.
Well, that says 2019 down the bottom.
Yes.
Okay, so
So this is 2018.
the standard deduction is 24,400, right?
Yes.
And then 1,300,
That's the catch-up provision. So if you're over
For
60
this year,
for this year, and
not
it
last
and
year.
it changes a little bit every year. So it's indexed, if that helps. Go ahead.
Does this change any way if you don't have regular income, it's just Medicare, I mean not Medicare, Social
where's
Security?
27,000?
Does that change any of these deductions?
Okay, so you're gonna look at your income, so whatever qualifies as income. So Social Security, we would have to figure out whether that is taxable or non-taxable, and we'll get to that discussion in just a minute. That's a good question. are we okay here?
I don't understand the arithmetic on this thing. You gotta
Okay.
start with 38, go to 24, 13. Where does the 27,000 come from?
Okay, so let me walk you through it again real quick. So at the top, you start with $38,000 in gross income. Okay?
Yes,
If we go to the middle column, what we're doing here is taking away all of the deductions.
yes, sir.
Okay, so in total, we're taking away the $27,000 from the standard deductions and the catch-up. That leaves you with $11,000. Okay, the 27 from the 38, okay? Then we're making an IRA contribution.
I don't know where the 27 came from. You've got
I'm-
$24,400 in standard deduction, and 2 times
You get-
1,300, which would be 26, right?
Right. So if you take those together, it gets to 27.
2,600 to 24,400, 27,000.
Yeah.
Okay, all right.
Does that help?
I'm off a comma.
It's
Sorry.
okay. I mean, I'd rather take the time and explain it and make sure.
2,600,
Okay.
26, 27, yeah. Okay, thank you.
No problem. So now we're gonna go talk a little bit about some more important tax rules and how they apply. Spend a lot of time on this topic. What I wanna get into a little bit is talk a little bit about required minimum distributions and the risks that are associated with RMDs, because this is really important. Capital gains, I'm gonna give you a few additional rules on capital gains that I didn't cover when we talked about the brackets. Social Security, is it taxable, is it not taxable? Medicare and how it's become income driven and how do we deal with that? And then I wanna talk a little bit about IRAs, conversions, Roth conversions, and how do we address those issues? So RMDs are required minimum distributions. What this is in the year that you turn 70 and a half, you are required to take money out of a qualified account. And when I talk about a qualified account, I'm talking about something like an IRA, a traditional IRA, that you haven't paid taxes on yet. The way we figure out what your RMD is we go to the very last day in the prior year, and then we apply a table, and the IRS will tell you exactly what you're supposed to take out by applying an appropriate divisor. So in this example, we have a $500,000 balance. We apply the table of 27.4, and we know that $18,248 needs to come out from the RMD. An example of the table, one of the things that you'll notice about that is that as you get a little bit older, it requires you to take out a little bit more. It's all based on mortality, okay? So this creates a problem and leads to one of the biggest risks that you do have in retirement, and I'm talking about sequence risk, okay? Or sequence of returns risk. And to boil it down, it basically means that you're forced to take out income at a time that you may not want to take it out. And this causes tremendous pressure on people that are retired because they need the income, and it's a very different ballgame for when you're building money. And I want to show you some examples. But basically, when we talk sequence risk, it's taking the money out and being forced to take the money out and recognize that as ordinary income and the impact that could potentially have on your taxes. This table will give you a little bit of an example of how sequence risk can wreak havoc and how it's different when you're in retirement or the distribution phase versus accumulating money. So here, we have an accumulator. This is a person that's saving money, doing a lot of the right things. They're earning an 8% rate of return. They start at age 41 and they go all the way to age 65. Now, the only thing that I've done differently between Table A and Table B is I've inverted the returns. They're the same numbers. And as you can see, when you're not in a position of having to take money, you can withstand this. As long as you're getting, a constant overall rate of return, each of these people were successful. Now, I want to show you kind of the same analysis, but let's shift gears and go from an accumulation phase to one of distribution. Here, you can see that the same person is still earning the same rate of return. The difference is that they're taking a 5% withdrawal from the account for income. Now, we still inverted the numbers, and you can see that one person went broke when they were in their 80s, and the next person made almost $3 million. So what was the critical factor here? Luck, right? That they just got better returns early as opposed to later, and they had better variance experience. They were both forced to take the money out. So sequence of returns is a big problem when you're trying to do income planning. So
Can you just, you lost me on it.
sure.
I don't know if anybody else is, but maybe I'm just.
No, go ahead.
Can you walk me through just what you said again? Because I mean, that's so extreme.
I know.
So what am I missing?
Okay, so they're starting with the same amount of money,
Right.
right? The $684,000.
Right.
The only difference between these two portfolios is we've inverted the numbers. So the guy that has portfolio A, he had to take that 5% withdrawal, and he had those early negative years. And we've seen examples of that, or black swans, or early negative years. It pushed the account value down while he still had to take money out. But the problem that this person had is he didn't have the time to allow that account to recover. He didn't do anything wrong, he just needed the money, and he had 3 tough years in the market. The other person was fortunate, right? They had 3 really great years. They had an opportunity to build up the account. He was still taking the 5%, same as the other person. But because of what happened with the market in variance, which we see that all the time, right? The variance caused this particular person to run out of money. So the point in showing you this exercise is not to frighten you, although the numbers are dramatic. But when we talk about income planning, distribution planning, you have to have a different strategy than one of accumulation. Because if you're forced to take money out or you need money to live on, you've got to create a plan and a process to deal for the rainy days, because there will be rainy days. And so we've seen that before.
But isn't that a function of a professional investment manager?
That's what I think he's saying, is you have to,
I'm just trying to get to the point.
you have to choose it wisely.
That's
So
what you're saying, I get it.
So professional investment managers help, right? But more importantly, you have to have a plan. You have to think about, if I need money or there's income that I know that's a constant that needs to come to me, what am I doing? What's my strategy? So if the market turns south, I can withstand that. And so that's what a lot of people don't think about enough, is that if I do need this money and the market turns south, and I don't have a crystal ball, the market could continue to be great, it could go down. But we've seen examples of extremes enough in the last 20 years to know that we experience both. But the point is you got to have a plan and a process to deal with the bad weather, because the bad weather will come from time to time. Go ahead, I'm sorry.
I'm just curious, you went through 2008, 2009, right?
Oh yeah.
What did you do?
Well, with most clients, what I try to, you have to start with a plan and a process. So you have to understand everybody's a little different. And I'll be honest with you, most people that were in business in 2008 and 2009, they knew the market was challenging. They didn't see the precipitous drop in October. So I could tell you that we knew that there was a tough market, that we were entering a recession. I remember having conversations in my office, but then the bottom kind of fell out in a week's time. So what did I do? My clients lost a little bit of money, but we tried to mitigate it. So it's hard to be completely right, but the other thing that I would tell you is the plan for income distribution might be different from one that you have that is still in that accumulation phase too. So maybe the plan was that if you had an income plan, maybe you have money on the sidelines that's not taking market risk. Because the key here is you don't want to be forced to make a decision when you don't have to make the decision. So you have to figure out, how do I build resources so that I can mitigate my risk or take less risk. So it's not always infallible, but there are absolutely things you can do to improve your situation. And so I think being cognizant of where you are, understanding where you are in the tax code, understanding what kind of income needs you have, and then building a plan so that you adjust your risk levels. So if we do have something that happens that's overtly negative, you're not going to be impacted quite as much. So that's how I would generally approach it.
Just generally, how do you feel about the market right now? There's so many indicators that it's fixing to tank.
There's some. So it's a very tough market right now. I mean, on
So
the
what
one,
do you do with your money right now?
I believe my honest opinion is that in the extreme short term, I still feel like we're in the, and this is just my opinion, I still feel like we're in the tail end of a growth market, but we have a lot of challenges right now. We have had some signs that historically have indicated that are leading indicators like an inverted yield curve. But the problem with this particular inverted yield curve, in my opinion, is it's been artificially induced. So I have to take that with a grain of salt. I'm not ignoring it, but it certainly is something that I'm looking at. But on the other hand, you couple that with you still have some good growth numbers too. And even though that we've been in a growth market for a prolonged period of time, I mean, I could still point to you and look at, people are still spending money, corporate earnings are still good, we're still getting a reasonable amount of growth. So I feel like we're still in a growth market, but we may be slowing. And I really feel like it's a situation where you have to look at it quarter to quarter and make the best decision that I can. Eventually we'll enter a recession, there's no doubt.
Yeah.
But I don't think we're quite there yet. That's just my opinion, and we'll see where we go.
Earlier on, displayed the table the IRS gives you, says what's the required minimum.
Mm-hmm.
How much does that table change? Have you seen it change significantly, or it stays pretty steady?
No, this is a standard IRS table. So most people use this uniform lifetime table. There's about 3 or 4 that you can use, but this is used by the vast majority of people. And it stays pretty constant year to year.
That's what I was listening for, is that
Yeah.
something you should recalibrate every year? Or
No, if this did change, you'd get plenty of advance notice about it too.
Okay,
So that's something that you can rely on pretty well.
okay, great, thank
Yeah.
you.
Go ahead.
So, for age 70 on down,
Mm-hmm.
we're really talking about R&D, yes?
Well, that's certainly one of the things that when you get to a point in time where you need to take money out,
Right.
you need to be thinking about how do I incorporate those payments, the forced income that I have to take out, into my distribution planning.
Right.
Yeah.
So, in this case, we're talking about either ordinary IRAs or 401k as the total pie?
Well, 401k is a little different. Okay, so if you have a 401k that's governed by ERISA, okay, you may be in a situation where you're still working and have a 401k and not have to take that money right away. I'm just keeping it simple that if you were to have an IRA,
Right.
okay, and you crossed over that magic line, you were 70 and a half, then you'd either have to take that distribution in the year you turn 70 and a half or no later than April 15th of the following year.
So you have
Go ahead.
5% up there.
Mhm.
So it could be ordinary IRA, it could be 401k.
Yeah, I'm trying to keep this pretty straightforward, so I'm not really talking about the nature of the income.
Right.
It could be ordinary income, it could be capital gains. What I wanted to show you mainly is when you take income out, that puts pressure on portfolios.
Mhm.
That's what potentially can create this problem with sequence risk. And the challenge that we have is the government knows that. That's why they've created these R&Ds. They want you to take the money out now because they know that they can get more income this way.
Then as a follow-up, in my opinion, one of the most painful aspects of today's law is if you don't take the R&D, there's a 50% penalty on what you don't take.
That's right.
So
You have to take it,
right.
or you have to have a plan to deal with it.
Right, so In your opinion, will that continue under the Secure Act, the same 50% penalty?
There will probably be a penalty, but I'm gonna talk to you about potentially how that might change. So one of the things, and I wrote a blog about it too, it's in your packet, but one of the things that they're talking about, and I think this will become law in December, is pushing the R&D date back to 72. And the other thing they're talking about, and I'm jumping ahead, is they might allow you to make IRA contributions after 72. And these are all in the bill. I've got a copy of the Ways and Means Committee bill as well. So it's just interesting stuff that I think has a high probability of passing before year end.
And the logic behind that is what, people are living longer, is that the logic behind it?
This is just a series of bills that Congress wants to pass to help people save for retirement because they know it's an issue. So this is their way of trying to address some of it without, going and making massive reforms. So, and it's not a perfect bill. I'll talk to you at the end about the pros and cons of it, but there are a lot of good things in it. So I'm hopeful that it'll be passed by December. Okay. So capital gains, just want to touch on something real quick with capital gains. We talked a little bit about capital gains and how that works on the ordinary income bracket. Another thing that I want to tell you about is that with mutual funds, you can has anybody had an experience where they've owned a mutual fund, haven't bought or sold anything, and had to pay taxes?
Yeah.
That's phantom gains. And what that means is every December, you're gonna get a letter, talking about if you've got investments or your mutual funds or whatever, and they'll talk to you about gains or losses in the portfolio. And it doesn't really matter if you sell or don't sell the positions, because with phantom gains, you're still on the hook for paying the potential tax bill. The point of this is it's important to pay attention to these year-end events. These year-end events can make a big difference in your total tax bill. So with capital gains, this is not a secret. This comes out every year, the second week in December. You have an opportunity that you have gains or losses in your portfolio. You can go out and sell positions and manage those accounts and take steps to reduce your total tax bill. So this is something to keep watch on, because you want to control your long-term capital gains, because in certain circumstances they can also increase your ordinary income. The net surtax, that's another thing that premiered over the tax. That just means that if you're earning substantial passive income, this can increase your tax by an additional 3.8% once you earn over $250,000. So again, this is just something to watch for, that if it does come out, you want to be cognizant of and pay attention to that and try to control that or keep your brackets under certain levels. So Social Security, I think we kind of touched on it a little bit earlier. So question is Social Security taxable?
Yes.
Yes.
Maybe.
It can be.
The answer is possibly. So originally when Social Security came out, it wasn't taxable, but it got reformed in 1994, and we got a new rule that determined whether or not Social Security is taxable or not taxable. It's called the Provisional Income Rule, and I'm going to talk to you a little bit about how it works. When we talk about provisional income, that's the rule that determines whether or not you pay taxes on your Social Security. To go over the mechanics of the rule, you take 1/2 of your Social Security benefit, you add it together with your ordinary income, you count dividends and capital gains, and then you look at certain non-taxable interests like municipal bonds, and determine, depending on where you come out on this provisional income test, will determine whether or not your Social Security is taxable. Clear as mud, right? So let's look at the threshold, and then let's look at an example, and I'll talk through it, because this is absolutely something, though, that can be controlled. Benefits tax threshold. If you're single and you've earned adjusted gross income over $25,000, you pay 50% in Social Security tax. If it's over $34,000, you pay 85%, sorry. Buried filing jointly, the 50% bracket starts at 32,000. The 85% bracket starts at 44,000. Now understand, this is after all of your deductions. So you get to count the $27,000 in deductions. The key here is, what's the nature of your income? Because if I have a lot of ordinary income, you can see very quickly how that might ratchet me up the earnings calculator and make that Social Security taxable. However, if I have a lot of tax-free income, or perhaps long-term capital gains, maybe not so much. Maybe the income's a little bit lower, and maybe I'm able to keep those taxes more under control. Let me show you an example. Here's the exact same earning potential, but on the left, we've got someone here who's making $50,000, but $40,000 of it is coming from an IRA, okay? The rest of it is coming from Social Security. So doing the test, you know, that IRA is ordinary income, and then we have to count 1/2 of their Social Security. Anything over that 32,000, we have to multiply by 50%, so we get that 9,000, okay? Anything over the 44,000, that's the second threshold. We apply that other 35%, and we see $11,100 potentially subject to Social Security tax. Let's look at another example. Here, the difference is more Social Security, less IRA withdrawal. So the Social Security, we're only counting 1/2, the IRA, we're counting full. So we're still going over the threshold, but only by $8,000. We multiply by half, that's 4,000. The difference is 11,100 versus 4,000. That's a pretty significant difference in terms of how you're taking the income. And I want to show you how that looks on your tax statement. Here you've got the 11,100, that's taxable Social Security. Other income, total taxable income, standard deduction, net taxable, and there's the federal income tax. So what pushed it over? It was that Social Security tax. The only difference here, we took the income from another source. You know, we didn't have to take it all during the ordinary income. So why is this important? When you get into retirement and you're forced to take income, a lot of times the Social Security creates tax traps. Because when you combine it with R&D, the nature of R&D is ordinary income. If you have to take ordinary income and then you have to recognize some of the Social Security, what happens? Well, a lot of people that are earning, you know, anywhere between $50,000 and $100,000 a year in retirement are getting a $6,000 to $7,000 a year tax bill every year, because a lot of it's ordinary income and it's triggering this tax bill. So what's the takeaway? If I have an IRA, one of the things that I might consider doing is paying taxes on that IRA once, to not have to pay taxes on it again. Because once I pay taxes on that IRA, I get a step up in basis. Now that's not a free lunch, but if I don't have to pay taxes on the IRA anymore, and I'm able to take money from that going forward, maybe I don't have to pay Social Security taxes anymore either. Because then all of a sudden that money's not in an IRA anymore. It's in a regular account.
Or,
You change it to a Roth?
yeah, is that what you mean?
It could be a lot of different things. I could convert it to a Roth, so anything that comes out of a Roth is tax-free. That's not taxable. But if I take money out of an IRA, if I take $10,000 out of an IRA and I go and open a brokerage account, and then the next year I take $500 out of that brokerage account, and it doesn't gain any money, how much do I have to pay in taxes? Nothing. Because I've already paid taxes. I got something for what I paid, right? I paid taxes on the IRA distribution. Now I have a basis in that money. So when I take money out of that non-qualified or brokerage account, I don't have to pay taxes going forward. So I can still take my withdrawals, but better yet, what else am I doing? I'm controlling my social security taxes, right? Because that's not coming out in ordinary income anymore. So the point is that the decision can be a little complex. It's not necessarily the rate of taxes that you're paying currently. It could be the asset location of all your different assets. So whether you have an IRA or a Roth or a brokerage account, you might want to think about these and think about, if I can use these with Social Security, if I can get enough income out that I'm staying below the income threshold, perhaps it makes sense to pay taxes now and be done, especially if the taxes are on sale, which is what I'm talking about a little bit. So there are a lot of things that you can do looking at all these different accounts, so this is definitely one of them. And Social Security, that's just something that you have to look at year in and year out. It doesn't, unfortunately, these thresholds, they're not indexed. When they came out in '94, the Clinton administration didn't index them, and they've never gone back and fixed that. So you really do have to take some steps to play around that. So, go ahead.
So if you hit 70 and a half, and you have to take out, I think it was 18,000 that year, it was on one of those things.
Well,
You
the
have to
example was $500,000 account. You need to take over R&D at a little over 18,000.
18,000.
That's right.
So you're saying that you can take that 18,000 and go into your IRA, change that to a Roth, and you still have to pay tax on that 18,000?
What I'm saying is that when you're taking money out of an account, it's important to look at the tax impact, but it's also important to think about going forward, or is there a better place for this particular money? Because IRAs are sort of a creature that when you're saving money, they're wonderful because you never pay taxes and it defers all the gains. But the gain changes when you go from one of accumulation to distribution. Now IRAs are the worst place to have money because they're tax inefficient, right? Because every time I take money out of an IRA, I gotta pay ordinary income. So the thought process is, if you know you're gonna have to pay, and the IRS is pretty clear on that, you've gotta take the money out, it's forced, okay? What's the most efficient way to pay for it? So not only rate, but are there things that I can do to improve my overall situation? And that's a facts and circumstance question, right? It depends on what accounts do I have? Do I have tax-free accounts? Do I have non-taxable accounts? Does it make sense to go ahead and pay once, knowing that maybe it costs me a little bit more, but I don't have to pay in the future? Is there some net positives to doing that? These are the types of questions that are important to ask yourself in coming up with a plan and a process and mapping all of this out, because when it comes to taxes, asset location is critically important too. So, and this has nothing to do with return, it has nothing to do with performance, it has everything to do with being efficient in your decision-making process.
I have another question.
Oh, okay,
How do you-
okay.
How do you
Okay.
get the taxable social security?
I'm sorry?
How do you get the taxable social security?
How do I get the taxable Social Security?
Calculate.
Well, what you do is whatever Social Security you have for that test, the provisional income rule, I think that's what you're asking me, you count 1/2 of it.
Okay.
That's the test. So 1/2 of your Social Security, plus all your ordinary income, plus your long-term capital gains, and you add all those together, and that's how you begin to determine whether Social Security is taxable or not.
Excuse me, sir, as I mentioned to you, I need to leave, but
Okay,
I'll get in touch with you, so.
okay, thank you for coming, I appreciate your time. Did you have a question?
I did, can you please clarify really simply? You mentioned a couple of times paying taxes on a certain account one time and then you don't have to pay it again. Just, can you
Sure.
run that by again?
That's a good question. So when I have an account like an IRA, and I've taken a deduction on it, which is the normal situation, most people that have IRAs, they haven't paid taxes on it yet. When I take money out, that's like, think of an IRA as a house. When you walk out the front door, you're gonna owe. You know, it's like a shell. But when you come out of that, let's say that I take $1,000 out of my IRA. That's a taxable event. So whatever your tax rate is, let's say you're in the 12% bracket, you're gonna owe $120 in taxes, okay? But you still have the $1,000, because you took the $1,000 out. You owe taxes on it one time. But now you have $1,000 that you've paid taxes on, so it becomes after-tax money. You can do whatever you want with $1,000, right? You could spend the money, you could grow the money, you could donate the money to charity. You have a lot of choices there. But once that's done, then future money that's out of that IRA, you're not gonna have to pay taxes on the basis, the amount of money that you paid taxes on originally, because you get something for your payment.
Oh, I think I got you now. So
Yeah.
you're not talking about that happening every year, you're talking about that one withdrawal.
Right.
That you go ahead and pay your taxes and then the remaining.
That's right. So when you have to do something like pay an RMD, all you're doing there is you're taking money out of your IRA or your retirement account. You're taking what the IRS told you that you have to take.
Right.
You're paying taxes on it, but you still get the RMD distribution. That's still your money. So now it becomes a question of, are there things that you can be doing to be more efficient in those tax bills? And that's what I'm talking about. Yeah? So we'll move past this. Medicare is means tested now, so just to point a little bit out of that, you just want to pay attention to this. If you have income over a certain level, then certainly that can add a little bit to your total tax bill. So as you come up on these income tax brackets, just know that that's a change under the Tax Cut and Jobs Act that you just need to be aware of. I'm going to talk a little bit about. Sure, go. Yeah, go ahead. Sorry.
Where did that come from? Because I saw some income-related premiums, excess premiums, whatever, and it wasn't that high.
So the first 170,000 is the plan cost, so they're not adding anything there. What's happening here is, as you get into the higher income brackets, and they give you examples of Part B or Part D, they're going to add a little bit of extra premium to be in the program. So this doesn't apply to everyone, okay? And for probably the vast majority of people, you're not going to run into this problem, but it's possible. And like anything else, if you notice that you're bumping up against a bracket, you just want to make sure that you do what you can to control that so that you don't have to pay these extra taxes. It's very much like the investment tax surcharge. If there's a way that you can avoid that, then you certainly want to try to take active steps to do that. I want to talk a little bit about IRAs and Roth IRAs and conversions, because we've talked a little bit about that already, but I want to talk about how we integrate those into our discussions of RMDs and sequence of returns and things of that nature. A traditional IRA is traditionally an account that grows tax deductible. So transactions and earnings will grow tax deferred. Withdrawals at retirement or RMDs are considered ordinary income, okay? And under the Tax Cut and Jobs Act, you can put contributions in there until you're 70 and a half, so we touched a little bit on that, okay? Roth IRAs are a little different. So with Roth IRAs, the money that you put in there is not tax deductible. It grows tax deferred, but all the money that comes out of a Roth IRA is tax free. So this is one potential option to think about when you have a regular IRA or 401k that rolls over to a regular IRA. What are some things that potentially you might be able to do to help the tax bill going forward? Well, one potential solution is you could open a Roth IRA, convert some or all of your money in a regular IRA over to a Roth. It's not free, so you'll pay taxes on the conversion, but once you're done, any money that's in that Roth IRA, including the gain, is tax-free. Also, when we talk about Social Security, money that comes out of a Roth IRA does not trigger any of those ordinary income rules. So if all of your money was in Roth IRAs and you got Social Security, your Social Security would not be taxable because you went ahead and paid for that. Go ahead.
Under the current law, do you have to let the Roth IRA sit for 5 years before
It's
it's
called the 5-year rule. So one of the things that you have to do before you can access the money is you have to have the Roth IRA open for 5 years. That's a good question. So a lot of times, even if you're not ready to fund a Roth IRA, it makes sense to open it, just to toll the 5-year rule, even if you're putting $1 in there. Because what's the downside? Then you've given yourself flexibility to have that Roth IRA, and maybe down the road you want to put money in there or fund it. So, good question. So, 5 years you have to have the Roth before you can access it, but once you cross that 5-year rule, you can get into it.
So when did they change that you could, is even after 70.5, or was that only with IRAs that it was, you couldn't contribute?
So you can't put additional money, under current law, you can't put additional money into those regular IRAs once you pass the 70 or the 70.5 rule. So, go ahead.
So if you had a Roth IRA that you established 6 years ago, but you didn't add any money to it over a 5-year period, this year, in year 6, you add money to it,
Yes,
a large amount, let's say,
yes,
it's past the 5-year.
that's correct.
You
Good
gotta
question.
wait another 5 years?
No, it's one 5-year period, so it's a holding period that you've got to satisfy, regardless of the amount of money that's in the IRA. So I could have $1 in the Roth IRA and I'm still satisfying the holding period.
And what is it tied to as far as growth?
The holding period has nothing to do with growth, it's just satisfy. There's a rule that says that if I have a Roth IRA before I can access withdrawals under the tax code, I've got to have the account open for 5 years. So it's just satisfying the toll.
But does it grow, like with the stock market, how does it grow?
Yeah, so I can put a variety of investments inside of a Roth IRA. I can invest in stocks, bonds, other types of investments, and you're gonna get normal market participation and normal growth inside of that IRA.
Same as a regular IRA?
Same as a regular IRA, and any money that comes out of that will be tax-free to you.
Is there a limit on that contribution like there is on a traditional IRA?
Yes, but let me clarify some things too. So, just like a traditional IRA, you can have a Roth IRA as well. You can make annual contributions to a Roth IRA so long as you don't earn a certain amount of money. Okay, once you go over a certain income limitation, you can't put money directly into a Roth IRA. There are other ways to get money into a Roth IRA when you get into higher income brackets, but you know we'll save that conversation for another day. But to answer your question, you can contribute to a Roth IRA just like you put money into a regular IRA. You can also convert money. So if you have a bunch of money in a regular IRA and you want to push that money over to a Roth, you can do that without regard to your income. So that's another way to get money
So you
into a
could
Roth.
start a Roth IRA anytime with any amount of money and hold it for 5 years and not pay tax?
Well, there are certain rules you have to follow. So you're limited each year in what you can put in from a maximum standpoint. You also have limitations from an income standpoint. So if you're earning too much money, you may not be able to fund that Roth IRA directly. But as far as the floor, if you want to put some sort of minimal contribution into an IRA or a Roth IRA, you can certainly do that and start a Roth IRA and start running that as well. So what's the takeaway here when we talk about things like IRAs and Roth IRAs and Roth conversions? Well, if you're trying to manage your taxes in retirement and you're trying to control your income and have a distribution plan, it's important to look at all these accounts together. And that if you have things like Roth IRAs or maybe even non-IRAs, using those in conjunction with normal income can be a real benefit. And that you have to look at those, look at your total tax bill, and make a plan or a process to figure out how do I do this to be most efficient when I'm doing income or distribution planning. Okay?
So on that Roth IRA, you have to have a job and get ordinary money so that you can put it into the Roth?
You have to have earnings, that's true.
Earnings, okay.
So, that's true, you have to pass an earnings test. So whatever your earnings are, if you're earning $5,000 a year and you wanna put a Roth, that 5,000 in a Roth IRA, you can certainly do that.
I assume many people here are married, so one spouse can have high income, one spouse can have low income, and it's the combined total that determines how much you can
You
contribute.
look at the household income for determining participation. So that's right, you wanna look at the total income earned and figure out whether or not that makes sense to put a Roth IRA together. Questions? That's good. So I wanna talk a little bit about the Secure Act and maybe what might be coming, because I told you that the tax code is ever changing. So we have an act that I think will be coming out at the end of the year. I put some information in your packet about it, just to touch on some things that might be changing. Their key pieces. One section is talking about repealing the maximum age for IRA contributions. So you can see how that would encourage people to work longer and still make IRA contributions. We're talking about making lifetime income portable. So we've never had that, like where if you have something like an annuity that has guaranteed income, you now might be able to move it over to an IRA without penalty. And that's an effort to replace the pension system that's kind of gone awry and you're not seeing pensions anymore. We're talking about having more participation in 401k plans. So people that are working fewer hours are now going to be eligible to do 401k contributions, so that's big. RMDs, or required benefit date, might move back to 72. I see this flux a lot, but 72 is what they're talking about. Expansion of benefits for the 529 plans, and elimination of the stretch IRA, so that's something that would be a downside. So one of the great things about an IRA is when you have an IRA, the ability to stretch out the payments over a lifetime to a non-spouse beneficiary. They're talking about changing that to 10 years, so that's a downside. But it's some pretty substantial legislation changes that I think will be happening, and it goes back to the point that the tax code is ever changing, and the best way to really keep up on this is just look at it year to year, and particularly look at it at the end of the year and consult a qualified professional where it makes sense. So what I want to do is, open it up for a little Q&A. I'm glad that we're starting to get a lot of questions, but I'll kind of, open all the topics up that we talked about for a few minutes. Let's just try to keep it topic specific to a lot of the issues that we've talked about today. If we get too much into the weeds, I'll be here after too, and I'll be happy to talk a little bit more and answer any questions that you may have. But I kind of want to open it up because it's your time, and if there's some things that you want me to go into more detail about or have some questions, I'll be happy to answer that. I see one back there.
During open enrollment periods, if somebody is tied to a corporation, in general, corporate 500 companies, will they match Roth IRAs?
No. So a company, the way they're set up traditionally is they're going to put out most companies will put a certain amount of money in a plan to satisfy testing rules. Sometimes that's called safe harbor. Generally, those contributions have to go into pre-tax benefit. The best thing to do with your benefit plans, they're all a little different. So you need to read your benefits plan and figure out exactly what the rules are inside the plan. They're changing all the time. A lot of them do allow Roth 401k contributions and pre-Roth 401k contributions. But as to your question about the employer contribution, currently that's still going to stay in the pre-tax box. Mm-hmm. Yeah.
What would you say would be or is there a maximum age maximum age for conversion from a traditional IRA to a Roth IRA?
I don't know, so that's really a facts and circumstance question, and I'm not really pro-conversion or anti-conversion. I just want you to be aware of the choices And that's the most important thing, because with the choices, a lot of it's gonna depend on your income level, your health history, your personal tolerance for risk, and how you feel about the tax, because it is a personal choice. I mean, you may listen to and not agree with everything I say up here today. That's okay. But knowing the choices and making an informed decision is the most important thing that you can do. Yes?
Where do annuities fit into all of this? Is that considered
So
ordinary income?
annuities are considered ordinary income. I think that the government is starting to recognize from a public policy standpoint that annuities might have a role in terms of guaranteed income. So I'm neither, pro or anti-annuity. I would tell you that that is one of many tools that you could potentially use to provide yourself with a guaranteed income stream. I mean, there's pros and cons to it. Some of the annuities may have fees or penalties that you need to be aware of and take into consideration. But the trade-off might be that they might, in exchange for maybe paying a little bit more in cost, maybe they provide you a little bit more in guarantees or take market risk off the table. So those might be some potential positives of an annuity. So I would say it depends on your individual situation and what you're trying to achieve, and if there's some sort of income benefit that you're trying to protect or create, then maybe there's a role for this. Go ahead.
We haven't talked about trust.
Mm-hmm.
So this was set up very much associated with not being in a trust. Could you share the positives or the negatives if those assets,
Well, okay.
IRA assets are in a trust?
So trusts follow different tax rules,
Correct.
and I don't want to go too down that rabbit hole because I'm talking more about taxes and retirement.
Okay.
So if you want to talk to me a little bit more about trust after class, I'll be happy to do that with you.
Thank you.
Yep. Sure.
When they determine the percentage that you have to take out every year after 70 and a half,
Yes.
is that across the board, everything that you have, that you, like in a Roth IRA, an IRA, an annuity, whatever, is that all inclusive?
No, so what they're doing there when we talk about required minimum distributions is we're looking at your accounts that are of a qualified nature. So by qualified nature, I'm talking about things like a regular IRA, that you haven't paid taxes on it. You may have some other accounts, maybe you have some accounts that aren't qualified, they're brokerage accounts, just normal investment accounts. Those aren't subject to the R&D test. So the government will look at all of those assets that you have, you'll total it all up, and then you'll run the calculation against that uniform table, and it'll tell you exactly what you need to take out. Yes.
Brad, can you speak just for a moment, the tax benefits today for 529 plans and what you see the future of that and how there could be expanding that, and is that something that is just available for family members? Like, is that something I set up for my grandkids, or can I set it up for the kid that mows my yard?
So I'm a big fan of 529 plans, and you've seen policy trends to gradually expand the role of those. So if you think back to what the public policy has been on those, is that it's been an expansive rule as what qualifies as a qualified education expense. So in the beginning, if you recall, it would just be for covering tuition, and then it got bigger. It started covering things like room and board, books, a computer. You can even do things like pay for lodging and rent, as long as you can justify it reasonably and rationally. That's something that a student will need for qualified education. And they're continuing to try to expand the language in this 529 plan. If you go and read the new proposal, they're trying to expand it to trade institutions. They want to encourage people to go back to school, to get a degree, to improve themselves.
Homeschooling.
Homeschooling, that's what's causing the holdup in the bill, by the way. That's Senator Cruz. So we'll see what happens there. As far as your question on the taxation, So you get a tax deduction when you put the money in. So I put money aside for my child, I get a tax deduction. And then the growth in there, as long as I pay out to a qualified education institution, that's tax-free. So from a tax perspective, it's pretty beneficial.
Does it have to be my child?
No, you can actually do a lot of different things. So a lot of grandparents like to give money to their grandkids. And so you have the ability to circumvent the generation skipping tax or things of that nature. So it's a pretty flexible investment too. You can change beneficiaries on it. So you can start with a child and go to a grandchild. So these are things that can take on a life of their own. I mean, I have clients that want to do perpetual education legacies through 529 plans, create the plans, pay for their kids' expenses, then keep them in a line and pass them down.
Is there a limitation on what you can put in?
Yes, there is an annual limitation on what you can put into a it varies by plan. There are a lot of different 529 plans too. So, but there are things that you can do to improve that. You can gift into a 529 plan, for instance, and you can do a 5-year lump sum gift if you want to do extra funding into a 529 plan. So it is quite possible to get a fair amount of money into those early if that's something that you desire to do.
What are the downsides to it? What are the downsides?
Okay, so one downside is that if you take money out of a 529 plan and you don't use it for education expenses, let's say that I go out and I buy a motorcycle, and then you have to pay a penalty plus ordinary income tax. So that's a downside. It really does need to be used to be effective for the educational purposes. So if you start using
in the state, right?
In the
state.
Well, I can use it in other states too. I can have a plan. I can do a 529 plan. I can be in Virginia and I can send my kid to college in California, and I can still access that plan. And that's not uncommon, by the way, especially here because we don't have a state income tax. So we really don't care, which plan we use. We just want the best plan. So a lot of people will pick plans that are not in Texas. Maybe they have more advantageous investments. Maybe there's other things that you can do. So,
I didn't know that. I'd always heard that you had to use it for your child or your grandchild, like in the state of Texas.
No, that's one option, but you have many.
In Michigan, if you want.
But it has to be used for education. That's the risk I've heard is, what if your child gets there and says, I don't wanna go to college?
Well, no, you can still get the money. There's just a penalty.
You'll go.
Yes,
Yeah.
there's a caveat.
It's not a use it or lose it proposition. It's just that if I take the money and I've earmarked it for education, and then I take it out and I spend it on a house, well, then there's going to be a penalty there.
So if I set it up for my son, he decides he doesn't wanna go to school, I can change the name on that to my grandson.
Well, you own the account, so the
Right.
key is I can change the
I can change the
beneficiary.
beneficiary to anyone I want, and it doesn't have to be a family member.
Yeah, this really got popular in the last 10 or 15 years because the old way, they'd use these unified trust accounts, but the problem of those were the kids owned them. I mean, so you could put money in these things and the kids would grow up and say, well, I'm not going to college, Dad, I'm gonna take your money and go on a cruise or something like that.
That's probably what I'm remembering.
Well, yeah, that was a problem,
It was
right?
kinda like, oh no.
That's what I did with mine.
Yeah, exactly. Exactly. So,
for a grandparent to put the money in, can we take the education credit on our income tax? If, say I've got 2 or 3 grandkids and I give them some money,
so we're kind of,
529.
it's a good question. So we're kind of twisting a little bit. So there are independent education credits, but they're not going to specifically tie into a 529 contribution. You do get a tax deduction for it though. So if
If they're already set up in a financial, with a 529,
Mhm.
Any contribution to an existing 529 is still deductible.
Yes.
Okay.
Yeah.
you can show that you put the money in.
What I picked up on is, could I qualify for an additional education credit independently of the 529 plan?
No, as a grandparent, can, say you've gotta take this money out and you decide not to use it that year when you're
Well, the 529's not following those retirement rules, that's not.
Yeah, but say you got the extra money that year,
Mhm.
can you put it in, divvy it out to the grandkids in a 529 and take it off, the grandparent take it off as a
Yeah, okay, yes, so
As
I
a
see where you're going now.
vacation credit?
So if you're trying to control your taxes and you want to give money to your grandchildren and take tax deductions, then that could be one of the strategies that you use to help out your grandkids and lower your tax bill in the process.
But is that considered an education credit or a saver's credit?
Neither. So a saver's credit is something completely independent with that. And I know it's a lot of material, but think about the 529 as a pretty specialized piece of the tax code. So when we're putting that money in the 529, you're getting a deduction for that 529, the 529 contribution.
Off your ordinary income.
Mhm. Yeah,
Okay.
yeah.
So is that line 53? That's in the credit section, right?
Yeah, that's right.
Brad, one last question on the
Sure.
529. You have experience setting up perpetual 529 plans, and is that the same as like I could use that as a legacy plan?
I have experience setting up 529 plans, and then the people who started them changed the beneficiaries as the needs of the plan change.
Okay.
So that's not all that uncommon. I mean, if you have a plan with multiple beneficiaries, you don't know exactly what their path is. You're just trying to create a good path for them. So maybe one person needs more money and one person needs less. So you reallocate the funds according to beneficiary designation. Or maybe you're done and you want to name people in the future.
Right.
So there's a lot of flexibility there.
Thank you.
You're welcome. Okay. So I'm gonna wrap up the Q&A for now. I'm gonna stay a little bit after to answer any additional questions. Just a couple of things. We talked, so tools for tax control. We talked about the IRAs, the Roth IRAs, using the non-qualified, using tax-deferred products where practical. And I think in many cases for really creating a sound distribution plan, it's blending these withdrawals. It's taking these rates and trying to control them as much as you can. Everybody's situation's a little different, but I do know with proper planning and a little bit of forethought each and every year, you can really maximize your ability to reduce your taxes and control your income distributions. So be aware of these tools for tax control. So I want to talk a little bit about next steps too. I really have appreciated the opportunity to speak to you today, and I want to invite you to come and meet with me individually, and I want to talk a little bit about that. The value is when you come and meet with me individually, the conversation changes. We go from more general to more specific, right? So it's a little challenging to talk to the audience of 25 when you want to make sure that their information is correct, but meeting one-on-one, that's really your opportunity to talk and for me to listen. So you're gonna get a lot more out of that meeting. I'll probably ask you a few questions in that meeting, not many, but common questions that I do like to ask people when they're in this retirement income planning is, what plans do you have in place to triple your income in retirement? Because that's important, because a lot of people are living 25, 30 years into retirement, and you have to have income plans to deal with it. What strategy do you have in place to deal with a severe market decline, like 2000 and 2008, a decline of 40% or more? What strategies do you have in place that if you or your loved ones weren't here, how would you be after the IRS came in and got their taxes? And finally, what are you doing to combat the rising cost of healthcare and long-term care in retirement? So those are 4 common questions that kind of hit all of the issues that are really challenging when we talk about retirement income planning. But, just bring yourself. It takes about an hour. You've got an appointment card in your folder today. I encourage you to drop those off. I've cleared some time over the next 2 weeks because I knew I'd be speaking today to meet with people.
Where's your office, sir?
I'm in Frisco. I'm at Teal and Timber Ridge, which is pretty close to the toll road in Stonebrook Parkway. I've been in Frisco for almost 20 years. I think you'll learn a lot. We have a lot of tools in the office that can help. We can illustrate your personal tax situation, really get specific about how we can really impact your bottom line. So I feel like you really will come away with some value. And what's the outcome of another meeting? It's only 3 things. Either you'll like what I have to say and you'll determine there's a basis to working together. You'll agree to part ways and be friends. Or you won't agree with what I said and you'll move on and call it a day. So that's really the way it works. You know, and I've talked about a lot of things today that are challenging. And, you know, I alluded to it in my opening that we have more challenges today than we've had forever before. And these decisions are very real and going to be very impactful on your bottom line for yourself and your family. But you have all the tools necessary to succeed. So with a well-crafted plan and some strategy, you know, I'm confident that you can overcome any of these obstacles that you have to deal with, and you don't have to do it alone. So, you know, we're here, we've helped hundreds of people since we've been in business, and we'd like to continue to help you. So please take the time to maybe come see me, drop off an appointment card, come meet my staff, and see if we can't make a difference in your retirement solution. So I thank you for being here tonight. I hope this was helpful. I hope that you got a lot of good answers to some questions. I'll stick around and answer any additional questions that you might have. Sherry's in the back here if you want to drop off any of those appointment cards or make a meeting. And I really appreciate your time. Thank you very much.
Thanks very much.